Hi, Steve Van Metre here, and welcome to your weekly economic update, where we take about 30 minutes every Friday to try to make sense of markets that don't make any sense. And sure enough, this week, they really don't. Now, I want to share something with you before we get into everything, because the credit data, I have nothing positive to say about this week. When we look at the lending data and you see what's going on, it's downright ugly. And you may recall, for those of you who've been watching for a little while, back probably, early December, where President Trump announced that the trade war was ending. I forget what week it was, but it was in the first half of the month. And at the time I said, hey, it seemed really weird because appeared that we were winning the trade war. Now, for those of you who are wondering, I'm not really a big fan of the trade war. I understand why we are doing it, and I understand and I support the reasons we're doing it. I get that, but from a position of the dollar as a world reserve currency, it's a terrible idea. I mean, it's not the worst thing in the world. The worst thing is the Fed could tighten monetary policy, but beyond that, if you understand what happened at Bretton Woods years and years ago, the whole idea was the United States needs to export as much work as it can. And I realize that, some of you watching this is, hey, I've had family members and friends that have lost their jobs to factories moving overseas. Look, I get that. I lived in the Midwest for 2 years, and when you live in that part of the world, you drive by empty factories every day. It's something that makes an impact. When you see what a town was and what it has become because of jobs being exported. But from a perspective of the dollar being as a world reserve currency, as a country, we need to export as many jobs as possible, because when we export jobs, we also export our debt and inflation. You can't run the system forever. It does have a failure point. So I get both sides of the deal. But in early December, when President Trump announced that a deal was made, the deal would not be made public. Then later on it was like, okay, well, it's going to be made public. And now that it's being signed next week, as far as I know, there's still documents not going to be made public, and China has not made any public comments. And we know what China's media comes from the top, from President Xi and his staff. So the fact that they're not making any comments tells us we don't even know what this is. And my comment then was something changed, because sometime in November, I think late November, there was a meeting between President Trump, Fed Chair Jerome Powell, and U.S. Treasury Secretary Steve Mnuchin. That meeting was not made public. They all made comments about it. But of course, I don't really believe whatever their public reasoning is. When you have the three power players like that meeting, unannounced, unexpected, something serious is going down. I thought my expectation was we would see a rise in unemployment claims, because whatever they were talking about, all of a sudden, boom, magically, that the trade war ends, which we know Fed Chair Powell is not a fan of. But then around that same time, the Fed increased the overnight dollar lending limits and the term lending limits, and they added some term facilities to their crazy lending scheme that they're doing, their dollar lending program. It told you something was wrong. So my impression was it had to do with employment, but we didn't really see. We saw some rise in initial claims, but it's tempered back down. Now, I believe we'll start to see that increase in the weeks to come again. We've seen this week some layoffs being announced, so my expectations are that's going to go up. But when I looked at this week's lending data, maybe that was the catalyst for that meeting. Because what we're seeing right now in the lending data is defaults. And a loan doesn't go default until it's delinquent for roughly like 90 days, and the bank tries to work with you to keep that from happening. But in a debt-based economy, under the design of our monetary system, you do not ever want large-scale defaults. Those of you who think the stock market is immune to that are wrong. Stock prices are not immune to currency destruction. Because what we're seeing so far, because when did the Fed start their repo operations, 3 or 4 months ago? Have had no effect. I told you they wouldn't. They haven't. But what we're seeing in lending day, when I get there, I'm not going to have anything nice to say. But let's talk about the Nonfarm payroll report. And I want to show you where you can get this data yourself. Now, I know a lot of content producers like to hide data or make their own charts. I like to share with you where I'm getting stuff because I'm looking for resources that are free and accessible. So if you listen to this for a while and you're like, hey, I've learned a few things and I can now get the information I want, and I don't need to watch anymore, that's totally cool. And if you still like what I have to say, I'm glad you're still with us. But I want you to be empowered to find the data and to interpret it. So let's go to investing.com, and you can go under news and economic calendar, and every day and for the week they will publish what's going on. And of course, and they publish it as it happens. Well, there's some foreign data that, they say it happened, but they don't get the report quite yet, but it does eventually get updated. But here we have non-farm payrolls missed expectations of 164K and came in at 145,000 jobs created. Now, if you click on this, it takes you into the details, and you'll notice there's this little yellow circle, and this indicates a revision. Now, non-farm payrolls are heavily, not only revised for the last 2 months, but then after a year or so, then they get revised again. And so that's why I think in March, or February or March, we're going to see a minus 500,000 downward revision for the year ending in March of 2018. So there's going to be a huge reduction in jobs. And the reason the Bureau of Labor Statistics does this is because, one, they don't have a means to accurately account for jobs. They don't know why. In our modern world of technology, they can't figure it out. The other reason they do it is they like to puff the numbers up, because what happens, say, a year and a half later, that you find out there was a downward revision of 500,000 jobs? Well, it's too late. You already invested based on a lie. So that's why they're not worried about it. Their idea is, we want to make it look as good as possible, and then we'll let you know later that it wasn't that great. Because the whole idea of a debt-based monetary system is you need to create confidence. As long as people are confident, they will spend, they will invest, and they'll keep the machine running. When you lose that confidence, the machine falls apart. So when you see these dots here, that means they were revised. So in December for November was 266,000 jobs. That was revised down to 256, and then 128 was revised up to 156. But we got 145,000 jobs, and about 80% of them were of part-time nature. So it wasn't, you would expect that in December for companies to do holiday hiring. And in turn, we would expect to see those jobs go away in January. So I'm going to make the statement this is probably the last of the good payroll reports. Not that I think this one was by any means great. The participation rate held at 63.2%. The unemployment rate is steady at 3.5%. So from the Fed's perspective, hey, look, we created over 100,000 jobs. That's great. The unemployment rate's the same, and it keeps the Fed kind of in a challenge, because they can't lower a challenging spot because they can't lower interest rates too much with unemployment rate sitting at 3.5%. So they can continue doing their behind the scenes stuff of buying treasury bills, but that's probably it. Looking at average weekly hours, were flat. Average hourly earnings decreased. This is not good. Their expectations were 0.3%. I shouldn't say they decreased, they increased, but they didn't increase very much. And the year-over-year rate of change on average hourly earnings fell. The other issue here is, I don't care what the broad average hourly wage is. That doesn't matter to me. What really matters is things like manufacturing sector. Now, I want to know what the production and supervisory employees are making. These are your blue-collar American workers. Because someone who works at, say, Taco Bell, I'm not worried about their wage. They're not a high-incomer, and most retail employees are not. Let's just face it, it's true. But at a transmission plant, say in Muncie, Indiana, they're union. Their wages are higher. So when their wages go down, That flows through the rest of the economy. So what I'm looking at this chart here, I have average weekly hours of production and non-supervised employees. And this was flat this last month, but you can see going back all the way to April of 2018, the amount of hours worked per week has been decreasing. And you'll notice in blue, which is very noisy, the total non-farm payroll report. I said last night I sent a message to my friend in Hong Kong. I said, I'm expecting a miss based on this chart. Well, we got a miss, but I actually didn't tell him I was expecting a much larger miss. I thought we were going to get closer to 100,000. But what this is telling us is employers don't really need to hire because they're not adding hours. Why do you hire workers? Well, because you're paying so much in overtime that it's cheaper to add a new employee. So the fact that hours worked for production and non-supervised employees in the manufacturing sector are not rising and in a downward trend tells me that future payroll reports are not going to be that great. And if we take that to the next level and we take those weekly hours of those same production and non-supervised employees and we multiply it by their average hourly earnings, which is really cool. And I kind of figured out that both these data points were in there, and it tells me something really important. You can see that wage growth for manufacturing sector is not that great. There are times they do well, but for most time their wages, they're not growing. And how does that happen? Well, simple. You cut hours and give people raises. But notably, you will see when the economy slows down, these people have their wages contract. And when you do that at the end of a cycle, so after 8 or 10 years out like we are now, and you see this start to fall, it's very recessionary, mainly because of all the debt in the system. And after say 6, 7, 8 years of an expansion, people have a lot of debt. And when you zoom in on this, what you can find out is since roughly the first, we'll say it's somewhere in between January and February of last year, these production employees in the manufacturing sector have seen their pay cuts drop 2.5, 3.8, 5.6, and are currently seeing pay 4%. That's quite a bit, 4% less than this time last year. That's significant. Again, I don't care if the person works at Taco Bell is making 4% less. I care about the guys used to making 90, who's got a base pay of $90,000 a year with full benefits and then is picking up a couple hours of overtime every week and is spending his money and buying stuff he can't afford. And when his pay gets cut by 4%, can he continue to make all his bills? That's what I'm interested in. So I look at this and I say, okay, average, hourly earnings are up 0.1%. I'm not worried. I'm not concerned about that because that brings in everybody. But I wanted you to see this data. Now let's go over to the PowerPoint here, and we'll continue to move along. The M2 money supply is starting to slide down. We're seeing money leaving money markets, and I don't know if it's going into bonds. Could be going into stocks. Who knows? Could be going to pay debt, but the growth rate was down to 6.95%. What we do know is there's a large amount. This money is just sitting idle. This growth here is just sitting idle in money markets, and it has not been deployed. If it gets deployed into the real economy, that can be very bullish. If it gets deployed into the bond market or it just sits here, it's very bearish for the economy. The 6-month rate of change held flat. The 3-month rate of change is down to 1.9 and sliding. Now let's go back to over here, and let's take a look at the assets and liabilities in commercial banks, and then we'll look at the charts. This is the H.8 report posted by the Federal Reserve every week, sometime after 1 p.m. Pacific. So we can see that going in the week ending January 1st, so that's I think the 3rd, the large commercial banks dropped $4 billion in Treasury securities. Again, we kind of knew they had to do that because of the Basel III regulations. But again, the selling did not really cause, they went from a peak of $3 trillion, so they lost 18, another 25, so that's $43 billion, and you did not see a big spike in interest rates, mainly because I believe they lent these to the Fed in exchange for cash. So I'm going to expect throughout the month and in the next month or whenever, as these loans come due, that this number should go back up. But that's why I don't believe we saw a big spike in yields that was predicted. But let's look at the rest of this. Total loans and leases down from almost 10 trillion to 9.985. So that is a pretty big drop. Look at commercial and industrial lending. We dropped 10 billion the week before, and now we dropped 12. Let me explain to you what you're looking at here. When you have $2.3 trillion, and this is a weekly change. So let's just pretend. Now, this is not looking at interest. So this is looking at the principal value of the debt. And you want to see this growing in a debt-based economy. This is really critical that you understand this, because what I'm about to tell you is why I'm very, very bond bullish. If I wasn't bullish last week or the week before, I'm even more so, because this is the biggest red flag that nobody looks at. This is looking at 52 weeks a year. Because every week this data comes out. So let's say the data dropped 10 billion every week. Because maybe you'll say, well, Steve, that could just be principal payments on loans. People are making, their loan payments, interest rates are low, so that's just principal payment, going down. Okay, that would imply that $520 billion of principal payments are being paid down against 2.3 trillion. That's not principal payments, my friends. When you see lending drop this much, a loan balance, effectively what you're seeing is loan balances dropping 10 billion and then 10 billion again. You're not seeing principal payments, you're seeing defaults. This is what I believe the Fed was concerned about, and Treasury Secretary Mnuchin were concerned about, and why they met with President Trump. Because they were pretty much saying you need to end this trade war because maybe that's causing some problems. Now, it isn't. It's causing some. It's not the Fed tightening monetary policy and the contractional world, all liquidity is a problem. But I want you to see this is bad news. This is lending defaults. And when a debt-based economy starts getting loan defaults, the recession's here. You don't see this during expansions. You see, this is very recessionary. Wait till you see the year-over-year data. Looking at real estate, only a minor increase of $3 billion in loans, so that's not very much. A drop of $1 billion in residential. The rest came out of commercial. Consumer loans, you'd think from the holiday season, hardly any increase. And looking at consumer loans, virtually no increase. I did hear from my stepson. So every time I look at the automobile loans, I affectionately say it's him. And I'm sure he wishes he was doing $1 billion of lending and car loans a week. He sells Audis here locally. And I'm sure if he was selling $1 billion worth of Audis, we would all know about it. But no, he did say there was an increase right at the end of the year. So he didn't make his December quota. And those of you that work in the auto industry know that's all that matters is what you did the month before. All right, so let's go back and look at the real estate loan data on a year-over-year basis. Growth rate is down to 3.85. This is very weak despite how low interest rates are. The 6-month rate of change and the 3-month rate of change are rising, but not by a whole lot. So this tells you from an interest rate perspective that rates are still too high. Still too high. Look at commercial industrial lending. This has never contracted before a recession, ever. Growth rate's down to 0.64%. Could contract within the next week or two at the current rate. 6-month rate of change is at 0.81. 3-month rate of change is at negative 0.81. 3-month rate of change is at negative 0.62. When the 3-month hits -1, it is done. And we're close. And if we're seeing defaults now, what do you expect the economy to do over the next several months? I mean, there's nothing. There's no more major haul. I mean, yeah, you got Valentine's Day, but it's not certainly Thanksgiving, Christmas, or New Year's. So what's going to drive the economy when you have April 15th coming? People are going to owe taxes. You have small business owners like myself that owe estimated taxes here in 5 days. And then we got to pay the rest of our taxes, of course, like everyone else. So you see, this is not a time of year that people normally are out spending. They normally start paying off their holiday debt. This is bad. This is bad news. The Fed's magic is not working. Looking at total loans and leases at all commercial banks, growth rates down to 3.89%. Again, this represents 1/3 of all the loans in the country. 6-month rate of change is at 1.64 and falling. 3-month rate of change is 0.78% and flat. Again, you'll notice that this thing doesn't go negative until after recessions, and it's not in a strong position at all. Looking at credit card growth rate ticked up to 4.82%, maybe the highlight of the data here. And so we know consumers spent into the holidays and charge it on credit, and that's probably going to reverse direction. Found this chart on Twitter from Pictet Asset Management, U.S. jobless claims versus average performance against the inverted yield curve. So here they said that I think there was a 22-month lag, but there is a lag between when the yield curve inverts and jobless claims rise. And as we have discussed and I've written about, when jobless claims rise, interest rates go way, way, way down. And looking at the biggest divergence between corporate profits and stock prices courtesy of Zero Hedge, people say, well, the market can only go up. Yeah, We'll see about that in the end. And CEO confidence is in the toilet, which leads the services sector and is suggesting the services sector is about to head into contraction in the months to follow. All right, let's go back to over here. Actually, let's look at me for a second while I get my PowerPoint lined up for the last slide we need. And let's go on to the NASDAQ McClellan Summation Index, proxy of liquidity. We see that the market is just trying to drive stock prices up. So what has been driving the market up? Quant computer programs are coming back in the market, and they're buying the dips, or they're trying to. Let's take a look at some other things of why I thought the Nonfarm payroll report was going to be ugly. We've got new orders for durable goods, which we should be getting an update on that I think next week or so. And you see that companies are holding on to employees. The only question is, will they start laying off? And I believe they will. And then let's take a look at the monetary base. The closest proxy to liquidity that world dollar liquidity that we have suggests that the Fed, who is going to scale back their dollar lending limits starting on Monday, finally got dollar liquidity positive. But don't worry if you think, oh, good, this is a saving grace. No, because the recessions happen around that time or after. I mean, you have to understand from a perspective of world dollar liquidity, this is the largest reduction of dollars in history. So not only do we have to get these dollars back, but we have to get the growth rate that we should have had from the expansion of dollars. Essentially, anyone who's expecting some magical rebound in the global economy, not going to happen. We may come back to how hedge funds are positioned. You know what? Let's just keep in mind that we still have this heavy short position in 10-year treasuries. We'll get an update on this Monday now that we're back to normal schedules. We still have this very deep position in 30-year treasuries. But let's go take a look at the charts, because I know I don't always give them the justice that they deserve. So let's go over here and let's look at trading volumes. So trading volumes are historically very, very low. If we go back out 20 years, you can see that we have weekly trading volumes that take you back to the early 2000s. And all that's telling you is that as prices go up, there's less demand. And typically what you see is in late cycle bull markets is you see share volumes rise as people chase them. But yet, you have to understand, half of all Americans either do not own or own a very negligible amount of stocks. They're not participating in this. So they're seeing it go up, and then they go and look at how much it costs to buy a share of the S&P 500 at $325 a share, and they can't afford it, and they're not buying. So that's going to be a challenge when all these people that are crammed into stocks turn into sellers. They're going to find out there are no buyers. And that is why you get big, deep crashes in stock prices. When everyone that's bought that wants in, eventually markets reverse, especially when you have this contraction in the lending data. Oof, that is ugly. Absolutely ugly. Let's take a look at 30-year treasury yields. And the reason let's look at 10-year and let's overlay the S&P 500, because there's this big jaw alligator jaw between these two. And we've looked at this before, and I tried to line them up, and you see this big divergence between stock prices and treasury yields. And normally when these happen, they need to get resolved. And so either stock prices go down or treasury yields go up. And you can see why did we build up what is, but maybe now the largest, but we do know for a fact it's the second largest speculative short position on treasury yields, because the market expected yields to rise to catch stock prices, because that's kind of usually in bull markets how it is. But when treasury yields resume their downward descent, as it appears they're starting to, because when you have, let me think about this, when you have the largest short position or second largest short position in history, not by much, and you can't get yields up, what does that tell you the direction of yields are headed? They're headed lower. What does it mean when unemployment claims start to rise? It means people don't borrow. Interest rates go down. What does it mean when you see commercial industrial lending defaults? That means interest rates are too high and banks cannot get corporations to refinance. The secondary issue you have there, which is a pretty big one, is over the next 5 years, this was scheduled to start this year, so we're maybe seeing some of the early phases. The largest amount of corporate debt will be refinanced over the next 5 years. And where are corporate profits? They're down. They've been falling for 5 years straight. Not a lot, but they've been down. Now imagine you're a corporation and you've got this debt that's maturing, and you go sit in front of the banker and the bank's like, yeah, I'd be happy. So you'd be roaring happy to refinance your debt for you. Let's take a look. Well, wait a minute. You're making less money? Yeah, we have a problem, because banks like to see their money come back. And when you're making less money, they start thinking that they're not going to get their money back. And what does that mean corporations will need to do? Well, Steve, you need to go cut your expenses. And you need to do it because I'm not going to refi this debt if you don't. And so what do I do as CEO? Maybe I go back and I say, call my executive team and I say, we need to get rid of people and we need to cut expenses. You kind of wonder why there's this mad dash of CEOs to pay any price to buy their stock back, even though they admittedly know the stock market's overvalued, because they're based on stock-based compensation. Number two, they knew this big corporate debt wave was coming. They knew they were going to have to refinance. So they wanted to get their bonuses and get their money before the writing hits the wall. But this gap needs to be filled. And so what we can see is the treasury yields are starting to roll over and come down, and that will drag stock prices all the way down with it. And that means there's going to be a massive deleveraging in the equity market. And if you look back at what goes on in the bond market, you can see there's an initial move down. Oftentimes there's a counter rally, and this one's really small, and either the counter rally takes off or you get a massive plunge as the market reprices risk. And you see speculators that are short the market have to buy bonds. You see equity prices fall, and those people buy bonds. I mean, the case to buy bonds is really simple. Retail investors don't own them. All of these weird, bizarre risk parity products are pretty much crammed into stocks, and they can shift to bonds but don't own hardly any of them. We know the quant programs have sold a lot of their bonds and are cramming back into equities. We know there's a huge speculative short position. We know the Fed's buying, and we know commercial banks have to buy. So there's not a lot of supply of bonds and a lot of people that need to buy them. And that's what happened is the Fed sets up this massive crash in interest rates. So here you see a move down, a counter rally, a final move down. You see a move down, counter rally, move down. Move down, counter rally, which is pretty small. And where are these going to go? Probably to zero. I believe the 10-year treasury yield will go negative. So let's take a look at TLT. How much? I'm just looking at the clock. Okay. We'll look at charts maybe on Monday, getting deeper. I want to explain what's about to happen in the bond market, because you're about to see the world's largest short squeeze in the history of the Treasury bond market. Now, to follow along, see where my mouse pointer is, but see to the right where there's this little bubble, this brown bubble that follows it. What you see over here is the 200-day moving average, the 50-day, and the 100-day moving average. But see how I'm going to move up and down. I want you to show what happened here on Thursday. So speculators, Monday, Tuesday, Wednesday, Thursday drove bond prices down, and then after a stellar 30-year Treasury auction, bond prices rallied back and they started to squeeze against the selling. And then today, the payroll report wasn't that great. So it squeezed against these shorts. So right here, and I want to show you why this triangle pattern is so powerful. because these people right in here are short. So what happens is you go up. Well, you go up a little bit more in price and you start to squeeze. So notice how this brown bubble is only up a little bit from this closing candlestick. It's only up a little bit, but you have a lot of selling right in here. And then you go up a little more and you've got some selling in here. You go up a little more and you've got selling, a lot of selling here and a lot of selling here and a lot of selling here. This is the big zone. When this dotted line starts getting cracked, you're going to see some people reverse position. And why am I saying this? Because when you're short the market and bond prices rise, you lose money really fast, especially if you took a speculative position in the futures market and your leverage, the leverage gains become leverage losses. And if you short it in the cash market, you're paying an interest cost every month. So not only do you have a high expense, but then you take a loss. So what happens is when people that are short get squeezed, which means a profit squeeze, or they start taking a loss, they will panic and sell. And when you're in a short position and you exit, you either indirectly or directly become a buyer and prices start to rise. So I want to show you why this is such a powerful reversal pattern. Because again, you get these people that start to get squeezed out of their position become buyers. Then these people in here, and notice how I'm barely moving up the price. This brown bubble is barely moving up a little bit, and we get another squeeze, a big squeeze right here. And then what? You get to this zone up here, a couple dollars higher. There's sellers in here. And then you get up here, there's sellers here. And then you get to the all-time high, the last of the sellers, and you get a shooting price movement. And I checked the Bible of technical analysis written following the Great Depression, and it said if you see a bottoming pattern, and then you get one of these triangle patterns following a bottoming pattern, most of the time it's a continuation of the trend. And we know that because we look at who is positioned. We see the speculators that are short, but look at the lending data. The commercial industrial lending fell $22 billion in 2 weeks. One more week like that, goose is cooked. Money's not in stocks, folks. It's in the bond market. I'm Steve Van Metre. Appreciate you taking the time to watch. We'll be back Monday to take a look at the most recent hedge fund manager positioning and see if there's been some more short squeezes in the bond market. The content of this video provides educational information only, is not intended to provide investment or other advice. Materials not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video or that I'm own do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.